In the world of investing, dividends are the closest thing you'll find to a free lunch. This simple idea is why many people love investing in things that give them extra cash regularly, like some special high-dividend ETFs. In this video, I'll show you 6 high-dividend ETFs that will help you earn a handsome passive income. I'll show you how you can turn it from passive income into actual monthly income over time. And in the end, I'll show you a dividend ETF that has the potential to make John a multi-millionaire and pay over $100,000 in monthly dividends. Coming up next are the 6 high-dividend ETFs ranked from modest to the highest potential for adding value to your portfolio. Let's start our list with number 6. Invesco S&P 500 High Dividend Low Volatility ETF with the ticker symbol SPHD. As the name suggests, this ETF tracks the S&P 500 Low Volatility High Dividend Index and holds a portfolio composed of the 50 highest-yielding, lowest volatility constituents of the broader S&P 500 over the past year. It has a current dividend yield of 4.53%, an average annual return of 3.9%, and a dividend growth rate of 6.57%. If John puts $10,000 into this investment fund after a year, it would be worth $10,843. Okay, that's not huge, but hold on. In 10 years, his investment would double to $23,705. That's better, but still not enough for a new Tesla. In 20 years, it would grow to $64,661 and pay him $4,339 each year. That's nice extra income, but not quite enough to stop working. But if he keeps it for 30 years, his $10,000 would turn into $211,135, giving him $1,506 each month, or $18,073 annually. Now that's a great return. Over 30 years, his investment would grow by $201,135, with $65,487 from the value going up and $135,647 from dividends. That's a nice chunk of passive income every month. This ETF focuses mainly on industries like utilities, consumer staples, real estate, healthcare, and materials. These sectors might not be very exciting, but they're dependable and steady, like the tortoise in the race. They might not sprint ahead, but they provide consistent dividends over time. Companies in the large cap category are generally big players with a market value of over $10 billion. They're usually safer investments with steadier cash flows compared to smaller companies. Value stocks are those that are priced lower compared to their earnings and book value. They might not grow as quickly as other stocks, but historically they've shown good long-term performance. They're kind of like the ugly ducklings in the story. They may not be impressive at first, but they can turn into profitable investments in the end. Next, at number 5, we have Wisdom Tree US High Dividend Fund with the ticker symbol DHS. This fund aims to give broad exposure to the large cap value category of the market. It's what we call a smart beta exchange traded fund, or ETF. This is a good choice for investors who believe in market efficiency. These types of funds follow market trends closely and offer a way to get market returns at low cost. So let's see what John can do with this ETF. It has a dividend yield of 4.33%, an average annual return of 3.96%, and a dividend compound annual growth rate, or CAGR, of 7.34%. If John puts $10,000 into DHS after a year, it would grow to $10,829. In 10 years, it would double to $23,697. That's better. In 20 years, it would be worth $67,294 and pay him $4,888 every year. If he holds on for 30 years, his initial $10,000 would turn into $244,642, paying $24,088 in annual dividends, or $2,007 each month. Throughout this journey, his investment would grow by $234,642 over 30 years, Capital appreciation would add $71,090, and dividends would add $163,552. That is a lot of extra money. The fund holds 388 stocks, but the top 10 stocks make up a big chunk of it, around 37% of the total. It only invests in American stocks, so it's like a domestic fund, but many of the businesses it invests in operate globally, meaning they make money from all over the world. So you could say it invests in global businesses based in the United States. They're like the American dreamers. They start in the US, but reach out to the world. Looking back over the last 5 years, many of these stocks haven't done well in terms of their stock prices. Almost all of them performed worse than expected, which is worrying. But if you're mainly interested in dividends and don't mind if your investment doesn't grow much, it might be okay. Despite the poor stock performance, many of these companies are actually good at increasing their dividends. Over the last decade, they've raised their dividends by anywhere from 35% to 270%, with an average of about 5% growth each year. This usually beats inflation, except for 2022, of course. At number 4, we have iShares U.S. Consumer Staples ETF with the ticker symbol IYK. This fund is sponsored by BlackRock, a big player in the investment world. It's gathered over $1.36 billion in assets, making it one of the larger ETFs focusing on consumer staples. IYK aims to match the performance of the Dow Jones U.S. Consumer Goods Index before fees and expenses. Now, let's see what this consumer staples ETF can do for John. It has a dividend yield of 2.69%, an average annual return of 7.45%, and a dividend compound annual growth rate, or CAGR, of 11.56%. If John invests $10,000 in IYK, after a year, it would grow to $11,014. Not a huge jump, but just wait a minute. In a decade, his investment would double to $27,625, more promising. In 20 years, it would be worth $88,162 and pay him $4,502 each year. If he holds on for 30 years, his initial $10,000 would grow to $347,824, giving him $2,160 per month and $25,915 annually. Now listen, if you think that's good, wait for the next 3 ETFs. All of them pay over $10,000 each month in dividends, and in the end, I'll show you an ETF that has the potential to make John a millionaire and pay over $100,000 a month. Okay, back to IYK. Throughout this journey, this ETF would grow John's investment by $337,824 over 30 years. Capital appreciation would add $176,906, and dividends would add $160,918. That's a considerable increase. The consumer staples sector includes companies that sell things people always need, like food, drinks, household items, and medicine, no matter how the economy's doing. This can be food makers, stores, and even farming companies. They keep us fed, clean, and healthy. The IYK ETF makes sure not to rely too much on any one company. It spreads its investments out. So if one company does badly, it doesn't hurt the whole fund too much. This helps keep things stable. Investing in this ETF means you're spreading your money across many different companies, so you're not risking too much on just one. Plus, it's cheaper than some other funds, so you get to keep more of your money. It's easy to buy and sell shares in the ETF whenever you want without any hassle, and they're open about what they invest in, so you always know where your money's going. Next up, we have Invesco KBW Regional Banking ETF with the ticker symbol KBWR. This ETF doesn't aim to cover the entire U.S. banking sector. Instead, it focuses on regional banks and thrift firms using a specific selection process by an index committee. This means it has a portfolio of smaller companies as it's focused on smaller market caps. The fund sticks closely to its goal without making big shifts. Recently, financial and banking stocks took a hit due to concerns stemming from the troubles of banks like Silicon Valley Bank and Credit Suisse. However, it seems this is more of an isolated issue affecting a few banks rather than a systemic problem. Overall, the U.S. banking system appears to be in better shape than initially feared, with earnings forecasts remaining strong. Hence, the reason why this ETF is performing well. It has a current dividend yield of 3.21%, an average annual return of 2.06%, and a dividend growth rate of 10.34%. Starting with $10,000, after a year, John's investment would have a portfolio valuation of $10,527. In 10 years, it would grow to $19,248, showing a nice profit. After 20 years, it would be $62,369, and he'd receive $7,783 in dividends each year. After 30 years, his investment would be worth $584,694, paying him an annual dividend of $140,364 or $11,697 each month. This ETF will add $574,694 to his initial investment, of which $47,271 would come from the increase in share price, and $527,423 would come from dividends. Now, you might not think these are big money passive ETFs, but wait for the next two. They're not just going to make you a couple $100,000, but rather make you a millionaire through dividends. In fact, the top ETF pays over $100,000 per month. At number 2, we have SPDR S&P Regional Banking ETF with the ticker symbol KRE. At the end of 2023, Bill Gross, often referred to as the Bond King, reported that he was buying the dip in regional bank stocks. John, following this advice, invests his $10,000 in KRE. It has a dividend yield of 3.31%, an average annual return of 1.44%, and a dividend growth rate of 10.94%. After 1 year, he'd have $10,475, which isn't that impressive, but with patience, the payoff is big. After 10 years, he'd double his money to $18,917. After 20 years, it would quadruple to $71,097 with an annual dividend income of $10,999. In 30 years, he'd have a portfolio valuation of $1,214,997, with an annual dividend income of $379,116 or $31,593 per month. In total, this ETF would add $1,204,997 to his portfolio, out of which only $48,625 came from capital appreciation, while $1,156,373 came from dividends. That is the power of compound and dividend growth investing. You might be wondering, why should we focus on regional banks instead of big ones like JP Morgan or Bank of America? Well, regional banks are quite different. They're smaller, more flexible, and really focus on their local communities. They're not as influenced by the same factors that affect big Wall Street banks, such as global markets, regulations, or scandals. Also, they're spread more evenly across the country, so they're not as vulnerable to regional risks or surprises. Now, let's talk about KRE, which is like many State Street ETFs. It's tied to an equal-weighted index, meaning it treats every stock in the fund the same no matter how big or small. This prevents a few large stocks from dominating the fund, which can happen with other regional bank ETFs like RKH or IAT. Plus, KRE has a lower expense ratio than its competitors, which means you get to keep more of your money. While options like IAT and RKH aren't bad, I believe KRE is the best choice for investing in regional banks through an ETF. And now, topping our list at number 1, we have First Trust Financial's Alpha Dex Fund with the ticker symbol FXO. This is a special kind of fund called a smart beta ETF. Unlike traditional ETFs that follow a market cap-weighted index, this ETF uses the alpha dex selection methodology, which is designed to generate alpha, or excess return, relative to the broader market. The Alpha Dex methodology ranks stocks within the financial sector based on various growth and value factors, including price momentum, sales growth, book value to price, and cash flow to price. Stocks that score highest on these factors are included in the fund, while the lowest-ranking stocks are excluded. This approach aims to capitalize on market inefficiencies and target companies with the greatest potential to outperform. The fund's composition can vary significantly from traditional financial sector ETFs, focusing on banks, insurance companies, and diversified financial services, emphasizing stocks based on specific financial metrics rather than market capitalization. And that's the reason why it's been performing very well. This ETF is all about dividends. It currently offers a dividend yield of 2.9%, an average annual return of 7.35%, and a hefty dividend growth rate of 17.23%. If John invests $10,000 in this ETF, his portfolio will grow to $11,025 in a year. That might not sound like much, but over 10 years, his investment will more than triple to $30,889. In 20 years, it'll shoot up to $177,353, giving him an annual income of $24,703 from dividends. And if he holds on for 30 years, his initial $10,000 will turn into an astounding $4,240,805, paying him $103,679 per month or $1,244,152 per year in dividends. Out of the $4,230,805 added to his initial investment over 30 years, $737,043 came from the increase in value, while $3,493,763 came from dividends. So this value added sounds good, right? But it takes time to grow. If you're in a hurry, watch our video on the top 5 AI ETFs for 2024 to see how to 10 times any investment in less than 5 years.